In this session, we're going to begin working with financial statements. In some of our previous sessions, we've talked about the various financial statements. We've talked about some of the information or types of information you can get from the financial statements, and we've even built financial statements. But we haven't gone into any detail as to how you analyze financial statements. And this is actually a very important skill to have. So that's what we're going to begin talking about in this session, and we'll continue to talk about it in future sessions. So to start with, accounting is often called the language of business, and this really is true because a firm's financial statements really are the primary tool it uses to communicate information about its financial strength and its financial performance. And so what we'll see is that financial statements contain a lot of information in a very compact form. But analysis is required to extract this information. So just to kind of illustrate that, let's look at a couple of actual financial statements. Okay, so here what I've done is I've downloaded Disney's annual report from their website, and in it we have their financial statements. We've got their income statement, their balance sheet, statement of cash flows, statement of retained earnings. All of those things are in there. And so what I've got pulled up right now is just their income statement. And if we look at it, we can see their revenues for each year. We've got the revenues broken down by service revenue and product revenue to get a total revenue number. And then we see some expenses. We've got a cost of services, we've got cost of products, we've got selling, general and administrative and other expenses, depreciation and amortization to get us kind of a total operating expense. Then they have an unusual item here, restructuring charge, and then we can see interest expense and some other items here going down to an income before taxes, income tax, and net income. Okay, now looking at this, we can see some things. We can see that Disney's income went down from the prior year. So in 2015, they had $8.3 billion in net income. It went up to 9.3, and now it's down to 8.9. But, you know, that's, without going into any kind of detailed analysis, that's really about all we can see about Disney is, yeah, they've got revenues, they've got some expenses, they've got positive net income, but how well are they doing? And that's something that financial statement analysis will let us do, is extract that information so we can really gain insight into different areas of Disney's performance. If we go down to a balance sheet, we can see the same thing. We can see, okay, here are their current assets, cash, receivable, inventories, and so forth. We can see what they were in 2016 and 2017. We can see what their fixed assets, long-term assets, property, plant and equipment is what I want to say, but apparently they call it parks, resorts, and other property. So we can see, you know, the level of their assets and so forth. If we scroll down, oops, too far, we see their liabilities and equity, so current liabilities, borrowings, and so forth. Now, if you'll remember, when we first talked about the balance sheet, we said it could give us a lot of information about the firm's liquidity and solvency. But just looking at this, can you tell me how solvent Disney is, or how liquid they are? And the answer is not really, not until you do some analysis to extract that information from the financial statements. And so that's what we're going to be learning how to do. Now, also, before we get started, I wanted to point out the difference between internal financial statements and external financial statements. And these are the financial statements that Disney has produced for its SEC filings, its annual report, and these are publicly available to anyone. Now, if you'll notice though, there's not a lot of detail on it. They don't break out their expenses in much detail. They've got cost of services, cost of products, selling, general, administrative, and other expenses, depreciation, and that's the bulk of it. But they don't break that down into, say, salaries expense and rent expense and various detailed line items. Okay, they don't make that publicly available. But if you were working for Disney and you were analyzing their financial statements, you would have a lot more detailed information. Now, I don't have Disney's detailed financial statements, but I've got some here that are from an actual bank, and banks are a little bit different, so we're not going to see revenues and expenses, or well, we're not going to see the same types of revenues. So I'm just going to scroll down to the expenses. Well, first of all, notice this income statement is 11 pages long. So this is an income statement, but it's one that was made for internal use. So it has lots and lots of different line items. And so if we look at their expenses, okay, 7 pages before I get to their expenses. But what we have here is we have salaries, we have overtime, we have temporary and contract personnel, weekend holiday pay, other compensation, 401k plan, bonus plans, all these different line items. Okay, more stuff here, employee benefits, other staff expense, occupancy, land improvements, depreciation on buildings. But we've got several pages of detailed line items about expenses, electricity, water and sewer, gas, other utilities. Okay, this is something you're not going to see if you're not working for the company. But if you are working for a company in accounting or finance, there's a good chance that you'll be dealing with these internal financial statements that contain a lot more detail than what you see on those that are publicly available. If we look at the balance sheet here, again, this is a bank, so a lot of their assets are loans and so forth. But if we scroll down to some of the fixed assets, we can see here they've got line items for land improvements, buildings, capital leases. They've got construction in process. They've got furniture and equipment, intangible items. They've just got lots of detailed information that you won't see on external financial statements. So anyway, that I just wanted to kind of show you, because what you see in a textbook or like the financial statements we built, they follow the same basic form, but the ones we actually built probably had more detail than the publicly available financial statements you typically see, but less detail than what you would see on internal financial statements. And we'll actually come back to these very shortly, and I'll explain what some of these other lines are, because some of these other columns are, because when we look at a public annual report, all we see are just the actual numbers for generally 3 years on the income statement and 2 years on the balance sheet. So let's jump back to our slides here. Oops. So again, why analyze financial statements? Well, financial statements contain a lot of information in a really compact form, but analysis is required to extract that information. So how do we use financial statement analysis in corporate finance? Well, one of the most common ways is what we'll call management by exception. And we typically use this technique looking at our day-to-day, month-to-month performance. So we've got a budget, right? And so one thing we may want to do is monitor our expenses and see if we're over or under budget on these expenses this month or this quarter. And if you're looking through your financial statements and you're way over budget on a particular expense, you may want to look into it and figure out, hey, what's going on? Why are we over budget here? And what can we do to fix it? We can also look at the variance from a prior period, right? What was this last month? Or what was it in the same month the year before? Or what was it last year? And so what we can do is we can look at those detailed financial statements that we have internally in the company and look for things that look out of line. Okay, so for example, if we go back to that detailed income statement we were looking at, and again, I'm focusing on the expense side because these are the financial statements of a bank, and banks are a little bit different, but the expenses are going to be pretty similar. So that's kind of what I'm focusing on here, is the non-interest expense. Now, so we can see right down the middle of the page, we've got the different line items: salaries, overtime, 401k plan, and so forth. So we need to make sure we understand what all these other columns are, and they're actually here to help us analyze the financial statements. So on the left-hand side, we've just got the current month. Okay, we're looking at a monthly financial statement here. It's for December, and so these are going to be the values for each line item in December. That's what this actual line is here. On the right-hand side, we've got year-to-date. And since this is December, this is the entire year. Okay, so for the year, their salaries were $5.8 million, and for December, the salaries were $509,000. Okay, now what we have right next to the actual column is the plan. That's the budget. So their actual for December was $509,000. They had budgeted $537,000. So they're slightly below what they had budgeted, and actually they're 5% below. That's what this percent variance is. It tells them how far off they were from plan. So overtime expenses for December were at $9,400. They had only budgeted $7,500, so they're 25% over on that expense for this month. Or year to date, they're 30% over budget on overtime. Okay, now that may be okay, right? Because they're under budget on salaries. Perhaps they had some open positions, and so they're using overtime and maybe some temporary and contract personnel, because they're a little bit over budget there, to make up for the fact that they have some open positions that haven't been filled. But when we talk about management by exception, what we're doing is we're going through all these detailed line items and looking for things that jump out at us as being out of line. So the 30% over budget on overtime, that might kind of jump out at me a little bit, but then if I look at it in association with the salaries, I think I'm okay. Because actually if you look at the total salaries, they're under budget by 6% for the year. Now if I'm looking at this next section, I see this 98%, that kind of jumps out at me. Well, what is that? It's the management incentive plan. They had budgeted $29,000 and they had $59,000 total. Okay, now if I'm management, I'm probably happy about that because that's some of my bonus, so maybe I don't look into this too hard. But in any event, you see something that's double what's budgeted, you might want to look into it and see what's going on. So if we scroll down some more, see what else we see. A lot of things under budget. 68% over on land improvements depreciation, but I mean it's only $3,000, so that's a tiny line item. I'm not too worried about it. Now I come down here and I see, hey, we're over 200%, 217% here. this I want to know what's going on. Okay, so we had budgeted 25,000 for maintenance and repair exterior, 60,000 for maintenance and repair interior, and these turned out to be, 190,000 and 78,000. So I want to look into that and see, hey, what's going on there? Why were we so far over budget? And it may be whatever it is okay. Maybe there was a storm that caused extra damage that we hadn't anticipated. But again, that's something we can look at. And we can do the same thing with the balance sheet. The balance sheet is also going to have the budget and so forth. We can look at that just real quick. So yeah, here you can see they show the period end. Balance sheets are a little bit different, right? They're the ending balances, but we've got, variance from plan. We've got prior month, prior year to date. And so you can do the same kind of thing with the balance sheet, but this tool is probably used a lot more focusing on the income statement, looking at controlling expenses, or even in the revenues section, you can see if the revenues are where you had budgeted them or what areas you're doing better in or worse in. So anyway, that should give you a little bit of an idea of kind of how that management by exception works. Okay, now another thing that we use financial statement analysis for a lot of times in corporate finance is evaluating performance. Okay, and this could be performance not only of the company as a whole, but also we could look at the performance of specific divisions within the company. We could look at specific departments, and we can look at specific employees. Okay, so most companies are going to have their internal financial statements where they can break them down by department. And if you're manager for this particular department, your performance is probably going to be evaluated, at least to some extent, based on your financial statements. How much income did your department generate, or how well did your department control expenses? And so that's actually one reason it's really important to understand financial statement analysis, at least the basics of it, even if you're not in finance or accounting. Because again, if you're a manager, there's a good chance your performance is going to be evaluated based on the financial performance of your department. So that's where we use it. Also, planning and review of projects. This is our capital budgeting. If you think back to chapter 1, well, when we're trying to decide what projects we should invest in, we're going to build pro forma financial statements. That's forecast financial statements. And we may evaluate those using financial statement analysis, maybe ratio analysis to see what we're forecasting. And then once the project's underway, we're going to be reviewing those financial statements to see if they meet up with what was expected. We may also want to look at the financial statements of our customers. Why would we care about our customers' financial statements? Well, maybe we're extending credit to them, so we want to make sure that their company is sound enough and liquid enough to pay its bills. Or we may want to look at our suppliers' financials, particularly if we have items we're purchasing with long delivery times. Maybe we're an airline and we're purchasing airplanes from Boeing or someone. Well, we want to make sure that the company we're buying from is sound so that they'll actually be around to deliver the products we're buying and to provide support for those. So we care about the financial strength and liquidity of both our customers and suppliers. And also, not on the sheet here, but if we're looking at mergers or acquisitions, acquiring other companies, we need to be able to analyze their financial statements and see how well they're performing. So that's just some of the ways we use financial statement analysis in corporate finance. We use it actually across the board in finance. In the investment side, it's again some very useful tool to have. The techniques that we learn in this section would be applicable if you were working as a credit analyst or a commercial lender at a bank and you need to analyze the financial statements of the firms you're lending money to. Or if you're an equity research analyst for a brokerage company and you're analyzing various companies to determine whether or not their stock may be good. You want to make sure the company is strong. Well, the same techniques that we use here would be useful in those situations, particularly the financial ratio analysis and common sizing that we'll get to. Those are very useful tools. So, okay, some techniques that we're going to talk about using here. The first one I've got up here is common sizing, or you'll hear this called standardizing or standardization. A very useful tool, and the basic idea with it is we're going to divide all the items on the income statement by sales, and we're going to divide all the items on the balance sheet by total assets. And we'll talk more about why we do that. We'll do some examples with that. It's a really useful tool, so we'll spend some time on it. The second item I have here is just calculating percent changes in various items. Okay, so your sales went from 100 million last year to 120 million this year. Okay, well that's a 20% increase, right? A 20% change. So that's very useful to see. How are your sales rising? But also, how are your expenses changing? Are they going up over time as well? And are they going up at a higher rate than your revenues? Because if your expenses are going up at a higher rate than your revenues, that's going to hurt your income over time. So how do you calculate a percent change? It's pretty easy. So the way you calculate a percent change in anything is just going to be your ending value minus your beginning value divided by the beginning value. So it's the change, ending minus beginning, divided by the beginning. Whenever we calculate a percent change, all we're doing is looking at the change as a percentage of that beginning balance. Okay, so if your beginning was 100 and your ending was 150, the change is you went up 50. 150 minus 100 is 50, and then you just divide that by the beginning 100 and you'll get 50%, which is the change as a percentage of your beginning value. Okay, when we get to the session where I talk about financial statement analysis in Excel, we'll do all of this. We'll common size financial statements in Excel. We'll also calculate the percent changes there. So we'll actually do examples where we calculate that. The next two items I have there are base year analysis and base year and common sizing combined. And I've drawn lines through these because they're not ones we're going to focus on. You do have a couple of slides from now, that defines these, and so I will mention them briefly when we get to that, kind of just briefly explain what they are and kind of what they tell you. But I really want to focus on the tools that I find most useful, which are the common sizing, the percent change, and the ratio analysis. So common sizing financial statements. As I just said, to common size a balance sheet, we're going to take every line item on that balance sheet and divide it by total assets. So it gives us each account as a percent of total assets. And when we common size an income statement, we're going to divide each line item by total sales or total revenues, and that's going to give us each account or each line item as a percentage of sales. Okay, so let's look at an example of that and kind of see why it's useful. Okay, so this should be in your handouts on Cougar View, so you can print it out and have it. But what I have here is I've got two companies, And these are really kind of made up companies. These aren't actual numbers, but I've called one of them McDonald's and the other one is Mystery Company. And what I want to know is which of these companies is better. Okay, so if we look at the financial statements here, McDonald's has sales of 789,000, net income, or million maybe, net income of 89 million. And our other little company, it's only got sales of 45 million and net income of 7 million. So, just at a glance, it looks like McDonald's is better. Okay, now one thing we can say for sure is McDonald's is bigger, but that doesn't necessarily mean that they're better overall. And common sizing will give us more insight into the differences between these companies. So let's common size these real quick. Okay, to do it, I'm just going to take each item and divide it by sales. Okay, and it's going to give me then percentages. So I can copy that down. And I'll do the same thing here. So for our Mystery Company, I'll divide each item by sales. Okay, now when we look at it, we've common sized them. We've taken scale out of the equation and are just doing everything as a percentage of sales. And we'll see here that overall, bottom line, Mystery Company earns 15.6% on its sales, where McDonald's only earns 11%. And so based on that, it looks like Mystery Company may be a little bit better. Okay, now not only that, we can see why. Okay, so McDonald's has a high cost of goods sold relative to its sale price, maybe because it sells things at a fairly inexpensive price, and so its gross profit is only 20%, where this other restaurant, they got a gross profit of almost 30%, 28.9%. And so then so it looks like they do a better job here just as far as their gross profit. Maybe they can charge a little bit higher prices and their cost of goods sold is about the same. Now if we look at the selling, general, and administrative expenses, now here our Mystery Company doesn't quite do as well. Here their costs are 13.3 compared to 8.9 for McDonald's. Maybe McDonald's is taking advantage of some economies of scale here, but overall, Mystery Company is giving you more net income for every dollar of sales. Okay, so this is a very useful tool for comparing companies that are different sizes. That's why it's called common sizing. But it can also be very useful for comparing companies over time, the same company over time. If we wanted to see, is Mystery Company getting better or worse over time, we could put several years here, common size them, and it would give us insight into that. So, for example, here we've got a company, and looking at it over time, 2008 through 2011 here, it looks like the company's doing pretty well, right? Sales are going up over time, gross profits going up over time. So, everything looks pretty good. Cost of goods sold is going up over time, but of course cost of goods sold is going to go up when sales go up. But if I common size this, now I see kind of a different story. Okay, over time, cost of goods sold is rising as a percentage of sales pretty steadily from 40% to 48%, which is causing our gross profit to fall from 60% to 52%. So again, you can see where the simple technique of common sizing, just dividing each item by sales, gives us a lot more insight into what's going on in the company. Okay, we can see, yeah, cost of goods sold is going up as a percentage of time. Why is that? I don't know, but we need to look into it, maybe find a better supplier, one that's cheaper, or something like that, because it's causing our gross profit to fall. So very useful tool. So you should have this summary sheet in your handouts. Again, just to kind of summarize, very useful for comparing companies of different sizes, and also useful for looking at the changes in a company's performance over time. Okay, so base year analysis, like I said, it's not one we're going to focus on, but it's actually kind of similar to a percent change. You'd pick a base year, an earlier year, so we're in say we're in 2017. We may pick the base year of 2015, and then we'll divide every line item for 2017 by the 2015 year base year. And so what it really gives you is kind of a percent change over a long period of time. How much has it increased or decreased by over this long period? And common sizing, or sorry, the combining of the base year analysis with common sizing is going to kind of tell you how much something's increased or decreased over time after controlling for the growth in sales if we're talking about an income statement, or the growth in assets if we're talking about a balance sheet. But again, I'm not terribly concerned with you knowing these in detail, but I did want you to see them. Your book does talk about them, and that way in the future if somebody talks about base year analysis, you'll at least have an idea of what they're talking about. But it's not one we're going to focus on. Okay, so I'm going to go ahead and stop here on this session, and in the next session we'll start talking about financial ratios.